Amid yesterday's sell-off, how are investors supposed to, who are exposed to a lot of big tech, which is just about everybody at this point, supposed to navigate an environment where yields are pretty much destined to move higher?
Well, that's always going to be a headwind for technology stocks, some more than others. There are what I call PS stocks and there are PE stocks. So price to sales stocks, those are the stocks that trade, that don't necessarily have a lot of earnings or free cash flow. So oftentimes but they have a lot of growth. So investors look at them on a price to sales basis. Those stocks will usually correct the most in this kind of environment. And then you can look at safer stocks that have well-established valuations. That's a Facebook, a Google, a Microsoft. Those would normally fare better. And then you also want to be selective in this environment and look for companies with specific catalysts in the back half, and companies are replaced. We particularly like Uber, Netflix, and Amazon remain our top 3 picks going into the end of the year, even in a rising rate environment.
All right, Mark, you're having a little bit of technical difficulties. We can't see you, but we can still hear you. I know you said Uber is one of your picks in the current environment. While we're hoping that your internet improves for a second, we've got to look at some of the tech stocks, at least their performance right now in the pre-market. You see Apple, Facebook, Google, Amazon, all of them up, most of them up just about 1%. A lot of fears about interest rates rising. They've risen very quickly over the last month, since the start of September, up about 20 basis points. Why are we seeing this rebound today? Was this people just buying the dip, or is there some other catalyst for these tech stocks to trade higher?
There's no particular catalyst today other than the dip buying from yesterday. The trade generally year to date has been to buy the dips on the leading assets, the highest quality assets. So the market's trying to put that same strategy to work today. Again, I think you need to be very selective in the stocks in the back half of the year. Not all tech stocks are going to be the same. And there are names that have done phenomenally well this year. Facebook and Google, we think they're more likely to be in consolidation phases, as most ad names are. We are looking for names with specific catalysts over the next 3 to 6 months, and those are ones that we prefer, and companies that are really levered to a kind of a full COVID recovery. And we're obviously still, relatively far from that condition.
One other, excuse me, Mark, one other area of tech, it is still early, sorry about that. One other area of tech I want to talk to you about is Fintech. You see Square and PayPal up big this morning. Is that just kind of some enthusiasm over their part in the holiday season and spending, especially with both of them exposed to buy now and pay later, things like that, very trendy stocks, or is there some other reason for those stocks to be trading higher?
I don't directly cover those, but you just mentioned 2 names that have obviously been around the market, in the market for quite some time. Especially a name like PayPal, really well-established financials and profit levels. So I think the market may well, if you're going to gravitate to high-quality tech, companies whose fundamentals are much more likely to survive in most environments, then those 2 names would probably be in that basket, along with some of the other well-known names, widely owned names that we discussed earlier. Again, the market will revert to those PE or price-to-earnings stocks that are easier to justify. They've got a lot of growth. They've got healthy margins. They've got a good track record. The market will first snap back with those before it'll get to the more speculative tech names.
All right, Mark, we're having some issues with your internet just a little bit, so we're going to go analog and go to your crystal ball. Right now, the yields on the 10-year, they're about 1.505. A lot of people concerned about the rapid rise. Clearly, not clearly, but it looks like they're going to continue to rise. What level can they settle at that will make investors feel comfortable to put their money back in tech?
I don't think it's a particular level. I think it's the rate of movement in the rates. So if you have a really rapid move up in the rates, that's what spooks growth investors. That's what spooks tech investors, those that have a long-term outlook, that where the value in the DCF, if you will, is in the terminal value, not in the next, not in year 1, year 2, and year 3. So it's really the pace at which the rates move up rather than the overall level. 1.5% fundamentally is a very low rate historically. I think we all appreciate that, but it's the move that matters.